Warren Buffett admits it doesn't really enter into his investment decision-making, and Tomasz Palehipetia calls it a complete fraud. Yet, ESG investing is becoming increasingly popular. Trillions of dollars have been invested in ESG globally, and the numbers keep going up. More and more people are interested in making responsible investment choices that align with their values. Why wouldn't they? It does sound very responsible and noble thing to do. However, it is not as simple as it sounds. If you're thinking about ESG investing, there are a few things you should know. In this video, I'm going to break down everything you need to know about ESG investing, the good, the bad, and the ugly. So you've probably been hearing a lot about ESG lately in the news or from your friends, but what is it? ESG stands for environmental, social, and governance, which are all factors that investors can consider when making decisions. In this video, I'm going to explain why they're important for you to care about and break down the pros and cons of ESG investing. Hi, my name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. ESG investing is an investment strategy that takes into account environmental, social, and governance criteria to generate long-term financial returns. These are often referred to as a triple bottom line, or people, planet, and profit investing. It started around 30 years ago from religious groups that wouldn't invest in companies that does not align with their beliefs. For example, alcohol and tobacco companies. It evolved from ethical investing to socially responsible investing and currently known as ESG investing. ESG factors are important considerations in the assessment of a company's overall risk profile and can impact a company's financial performance. We will see how later in this video, so stay tuned. Let's dive into each letter in a little more detail. Environmental factors. A company's impact on the environment, including its emissions, waste management practices, and resource efficiency. Social factors. A company's impact on society, including its treatment of employees, suppliers, and customers, as well as its involvement in controversial activities. Governance factors. A company's management and ownership structure, as well as its compliance with laws and regulations. There are a number of benefits to ESG investing, such as supporting sustainable development goals. One of the most appealing aspects is that you can align your investment choices with your personal values, voting with your money, so to speak. You can support companies that are working to improve the environment or create social change. For example, you can choose to invest in companies that are working to reduce their carbon footprints. However, the benefits of ESG investing go beyond simply making a positive impact on the world. Generating long-term financial returns. You may also be able to earn a higher return than you would from traditional investments. Studies have shown that companies with strong ESG practices tend to outperform the market over the long term. In fact, a study by MSCI found that the highest scoring companies of its ESG index outperformed the lowest scoring by around 3% per year from May 2013 to November 2020. As a consumer, you're probably already voting with your money by buying from brands that positively impact society or avoid the ones who do harm to the environment and society overall. Back in college, my European classmates would tell me how they avoid certain brands due to their use of child labor in their operations or the environmental impact the fast fashion industry have. In the US, this has become popular through the rise of the woke culture. Also, it is easier for these companies to attract talent, thus less expenses on hiring, which all contributes to the bottom line of the company. Reducing risk. ESG investing can also help you diversify your portfolio and reduce your overall risk. This is because companies with strong ESG ratings tend to have less volatile stock prices than those without them. They're also less likely to be involved in scandals and other negative events that can damage their share prices, including improved employee morale, lower operating costs, and reduced regulatory risk. When a company is proactive in addressing issues that may arise when a new policy is enacted, they reduce the chances of being sued or run into unexpected expenses. Criticism and challenges. While these benefits are real, it can be difficult to accurately identify strong ESG companies. The first thing to understand is that ESG ratings are measured differently and are inconsistent. The lack of standardization around what actually counts as an ESG-friendly investment can make it difficult to know whether you are truly aligning your investments with your values. There has been a lot of debate about the best way to measure a company's environmental, social, and governance performance. Some experts are increasingly skeptical that ESG scores have any direct correlation to more sustainable business practices. In fact, they argue that these ratings may do more harm than good by lulling investors into a false sense of security. They point to instances where companies with high ESG scores have been embroiled in scandals, or where companies with low scores have made a significant stride in sustainability. The bottom line is that sustainability is a complex issue, and there is no easy way to measure it. There are widespread and repeated changes to ESG scores, which makes them unreliable when it comes to using these reports to assess a company's ESG performance. Moreover, these changes are made without any public announcements and have a retroactive effect, meaning a company that had a lower ESG score, say a year ago, would have a high score simply because the new changes are more favorable to the company's ESG performance and has nothing to do with what the company has done differently to improve those scores. To put this into perspective with numbers, a study by MIT researchers found that just between February and March 2021, 85% of firm scores have changed due to these changes in scoring ESG elements. The study has mentioned that the ESG rating companies have a vested interest in creating a positive relationship between ESG scores and company returns. After all, if they can't demonstrate that their ESG scores are useful for investors, then they won't be able to make money on those reports. It's also important to do your research before you invest. Not all companies that claim to be socially responsible are actually living up to their claims. Make sure you know where your money is going and how it's being used. Critics of ESG investing argue that the field is nothing more than a marketing ploy. They claim that companies and investment firms are only interested in promoting their own sustainable practices rather than actually making meaningful change. After all, companies can fake their way to a good ESG score by simply paying lip service to environmental, social, and governance issues. In fact, some experts believe that the current emphasis on ESG scoring may do more harm than good, as it gives companies an incentive to game the system instead of actually making meaningful changes. So while ESG scores may look good on paper, they may not always reflect the reality of a company's sustainability efforts. Others say that ESG investing is simply a way for wealthy investors to feel good about their money, without actually doing anything to help the environment or society. There is some truth to these criticisms. Many companies do use sustainable practices as a marketing tool, and some investors are more interested in making a statement than in actually supporting sustainable initiatives. However, this does not mean that ESG investing is all bad. If we're going to make progress on this important issue, we need to continue to experiment with different approaches and learn from our mistakes and hopefully develop a more standardized approach. There are many ways to make sure your investments are having a positive impact, and there are plenty of companies that are genuinely committed to sustainable practices. I'm not siding with any point of view. I'm simply here to tell you both sides so you can make a better decision for yourself. Always be skeptical about any claim, be that from the company itself, any ESG fund, or a rating agency. Let's not forget the biggest rating agencies, including the S&P, Moody's, and Fitch, were fraudulently inflating the ratings of certain debt securities, leading to one of the biggest financial crises in 2008. Like anything in Wall Street and corporate world, you cannot trust anything at face value. Always question everything and look for evidence that proves otherwise. That's the best way to preserve your money and grow it without unnecessary risk. Let's discuss how you can incorporate ESG investing into your portfolio. There are a number of different ways to invest in companies that have strong ESG ratings. For example, you could invest in an ETF that tracks a broad index of companies with good ESG ratings. Or you could choose to invest in individual stocks of companies that you believe are making a positive impact on the world. There are various ways you can pick individual stocks. Number 1, positive screening. Select companies that are actively contributing to social or environmental change. Number 2, negative screening. Exclude companies that are harming the environment or are involved in social issues. Number 3, best in class. A company that has performed better compared to others in the same business. For example, funds would invest in an oil company that has done better than other oil companies, even though oil companies generally are not environmentally friendly. So this approach is a little debatable. Number 4, exclusionary approach. It's where you exclude the whole category that you don't want to include in your portfolio. For example, tobacco, companies that are involved in guns or cigarettes. If you're thinking about adding some ESG investments to your portfolio, be sure to do your homework first. Do some research to find out which companies are truly committed to making a positive impact. Otherwise, you may be doing more harm than good. Here are a few things you can do to get started. First, research the company you are considering investing in to see if they align with your values. In most cases, if not all, you will have to make a compromise between different factors. For example, Amazon is lowering their carbon footprint through committing to net zero carbon emission by 2040. However, they're killing small businesses and using their data to produce the items through Amazon Basics, which is not a very socially responsible thing to do. You can also look for ETFs that focus on ESG investing. ESG funds may not be all they claim to be, so you need to read into the fund prospectus to see what they are investing in and whether that aligns with your value. Finally, make sure to keep an eye on fees, as some ESG funds come with higher fees than others. If you're interested in making a difference with your investments, then ESG investments is definitely something you should consider. It's a simple way to support companies that are making a positive impact on the world while also potentially earning a higher return on your investment. While there are some challenges to ESG investing, the potential rewards make it worth considering for many investors. With careful research and due diligence, you can find investments that align with your values and help you achieve your financial goals. Even investing just a small amount of your portfolio will have a long-term impact. So what are you waiting for? Start researching ESG investing today. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time.